Okay, so once again, good morning, all of you, and I welcome you back to our next video, which is regarding financial market. So it is in the continuation of the previous video. So in this, we are going to see what financial market is, what are the different types of financial market, what we mean by stock market, okay, and various other terms. So this is really gonna be interesting. So my name is Priyanka Mahanta, Assistant Professor of Business Administration Department, US team. So let's begin our session for today. So now we are moving on to the next slide, which is classification of financial market. So in this, we can see what are the various classifications of financial market. So you can see here the financial market is first divided into two groups, which is known as organized market. Another one is unorganized market. So under organized market, they have capital market and they have money market. Then again under capital market, they have industrial securities market, government securities market, long-term securities market, and under money market, they have call money market, then commercial bills, treasury bills, short-term loan market. And under industrial securities market, again, it has been classified into two market, which is known as primary market, and another one is secondary market, which we have seen in the last slide. So we will understand this whole classification of financial market one by one. So what is the meaning of capital market? So capital market are financial market for the buying and selling of long-term debt or long-term securities having a maturity period of 1 year or more. So this market channels the wealth of savers to those who can put it to long-term productivity or useful use, such as companies or government make long-term investment, capital spending. Financial regulators or watchdogs such as Security and Exchange Board of India oversees the capital market in their jurisdiction area to protect investor against fraud, dishonesty, among other duties. Now, this capital market, what is the capital market? See, capital market is a market where buying and selling of long-term debt, or we can say long-term debt and securities of any companies are traded over there. Okay. Now, here it's written again the same line that it channelizes or it helps. It is a mediator between the one who has lots of money, okay, like the investor maybe, he has surplus of money with him, and between the company who is in need, who needs that money to restart the business or maybe to finance the business or maybe to get some new projects done. Okay, there may be many reasons why the company needs the finance. So it helps, capital market helps the investor or the surplus, like a surplus money to get into the one who needs it. So definitely it helps here. How it helps? The investor will get profit, right? He is going to earn profit out of it. And the another part, the receiver who is receiving the money, maybe the company. So this money will help them to growth in the company, to make growth in the company, because they are going to use the money for growth, right? For future growth of the companies. Now, there is another term known as Security and Exchange Board of India, which is also known as SEBI. So, what is SEBI? Or what is the role of SEBI? Why does this organization came into existence? What is the need of this board? These things are to be discussed in the later slide, but still now we will just understand what is SEBI. See, in the stock market, okay, there can be various frauds, okay, dishonesty, but it is the responsibility, there should be one responsible organization or subsidiary body that should look over the, we can say, the stock market, so that the person involved in it, or the buyers or the sellers should not be get involved in any kind of such frauds. Okay, like we all have heard about Harshad Mehta case, right? So what is the Harshad Mehta case? See, he has done some kind of frauds over there. Okay, a big fraud over there, which has what to say, impact all over the nation's economy, right? Through what? Through the stock market itself, right? So the need of Securities and Exchange Board of India came into existence, that there should be certain kind of rules and regulations, and the stock market also should follow certain kind of guidelines while doing that trading, so that the buyers and the sellers involved in that trading should not get exploited. Okay, should not be should not get into trap of any kind of frauds. Okay, that is why the Securities and Exchange Board of India came into existence. They look over the stock market, they see whether all the investors' rights and jurisdiction are safe or not. If there is any kind of fraud, then they are there to look over it. Okay, so finally, we can say that it is a kind of ruling body over there. Okay, now moving on to the next one. Let's see the feature characteristics of capital market. So the first one is link between savers and investors. So we already discussed this, but let's go through this again. It means that the capital market acts as an important link between the savers, or we can say the investors who has surplus of money, okay, and the company who needs the money. Okay, so the savers are lenders of fund, while uh, investors are borrower of fund. Okay, the saver who do not spend all their income are called surplus unit. So here the savers who are the savers, they have not spent all their income, but they have extra some money with them. Okay, like the surplus units with them, right? The capital market is the transmission mechanism between surplus unit and deficit unit. Okay, it is a conduct through which surplus unit lend their surplus fund to the deficit unit. That means the person who has surplus funds with him, they try to transfer it to the one who is in need. But in case there is a mutual thing, right? Even if, why should I invest without any kind of return? So definitely the person who is investing, he or she is going to get some kind of return out of it. Okay, without any kind of return, no one is going to invest over there. It's true. Now next one is deals in long-term funds. So capital market provides funds for long and medium term. Okay, that means more than 1 year. Okay, less than 1 year is not traded over in the capital market. In all capital market, only the long term securities are traded. Okay, long term, or we can call it as the medium term. So it does not deal with channelizing saving for less than 1 year. Okay, so less than 1 year transactions or securities are not traded in the capital market. Next one, utilizes intermediaries. Who are the intermediaries here? So let's understand this. So capital market makes use of different intermediaries such as brokers. Okay, who are the brokers over here? See, brokers are the one. Okay, suppose I need to purchase one particular company's share, but I don't have enough time to see when the price is going up and price is going down. I don't have enough knowledge about the stock market and all. So what I can do is that I can hire a broker. Okay, I can hire a broker. That particular broker will be the registered broker of SEBI, under SEBI. Okay, he should have a registration under SEBI. So I will tell him that I need this number of shares of this particular company. Suppose I need 100 shares of Reliance company, but I need at, suppose at this particular price. I will tell all my requirements to him. Okay, at how much price, how much you need, of which company, these things. So the broker will do the transaction in my place over there. Okay, so he will like purchase the shares. Okay, and once he purchases it or once he sells it, whatever I told him to do it, at the end of the we can say trading, he will provide me all the documents related to the trading, and in case of that I need to provide him a brokerage charge. Okay, he is going to charge some kind of brokerage. Definitely he is not going to do free of cost for me, so I need to provide him some kind of brokerage. Okay, some percentage of whatever the profit I earned over there. So capital market, what it does is that it makes use of the brokers, the underwriters or the depositors, etc. So these intermediaries acts as working organ of capital market and are very important element of capital market. Next one is capital formation. So the capital market provides incentives to savers in the form of interest or dividend, right? That means if I'm investing some money in the company, I am going to get some kind of interest from it, or else I'm going to get some kind of dividend from it, right? Dividend means, if you don't understand the term dividend, let me explain you. Suppose if you are purchasing the equity share of one particular company, or it may be preference share of one particular company. Now there is a difference between equity share and preference share. We will discuss this later on, little by little. So when you are going to purchase the equity share or preference share of a company, that means you are investing your money over there, right? You are investing your money over there and you are purchasing the share of that particular company. That means at that point of time, you become the owner of the company. Ultimately, okay, you become the shareholder of the company. So when you become the shareholder of the company, it is responsibility of the company to give you some kind of return for your investment done in the company. Like their invest dividend depends upon the board decision. Okay, board of directors decision ki how much percentage of dividend is to be announced this year. Okay, they do some kind of annual general meeting and they decide over there how much percentage of dividend is needed to be provided this year. So accordingly they provide the dividend. Dividend means it's a kind of return, interest. Okay, like we say interest, no, we give interest to whom? To the bank, or from whoever we are taking loans and something like that. But when we are giving return to the owner, we don't term it as interest. Okay, because they are the owner of the company. Okay, if I'm purchasing some shares of one company, I become the owner. So for owner, that term of return is termed as dividend, not as interest. Okay, so now for example, if I'm going to purchase debenture of one particular company, now what is debenture? Debenture is a kind of we can say loan that the public gives to the company. Okay, now it's a kind of loan, as I said. Company will try to raise the fund using debentures. That means the company is going to raise the fund from the public as in the form of loan. So whenever they are taking the loan from public, they are going to fix the interest over there. Okay, beforehand itself, like 10% or 9% or 12%, whatever. So they are going to fix the interest on dividend beforehand itself. Now, as debenture means providing loan, here I am giving loan to the company. That's why the return I am getting is termed as interest. Okay. Now, but in case of equity share and preference share, if I purchase the equity share and preference share, I become the owner of the company. So the return I get is termed as dividend. So I hope it's clear now what is difference between interest and dividend. So here utilizes capital formation. So the capital market price incentives to savers in the form of interest or dividend to transfer their surplus fund into the deficit unit who will invest it in different business. So the transfer of fund by the surplus unit to deficit units leads to capital formation. That means if I have more money with me, I have surplus of money with me, and I am providing my money to the company who is in need. So when I'm giving the money, that particular business is definitely going to use the money in some or the other way, right? In different forms of business. Ultimately, it's what? Generating income, generating capital. That's why it's termed as capital formation, which is the main characteristics of capital market. And the last one is government rules and regulations. So the capital market operates freely but under the guidance of government policies. So this market functions within the framework of government rules and regulations like the SEBI, okay, which is the government body of the stock market or the stock exchange. Moving on to the next one. So the next is an ideal capital market is one. So let's see what ideal capital market means. So ideal capital market means where finance is available at reasonable cost, which facilitates economic growth, where market operations are free, fair, competitive, and transparent. It must provide sufficient information to investors and must allocate capital productively. Okay. Next one, importance, or we can say the functions of capital market. So let's see the functions of capital market one by one. So the first one is linkage between savers and investors. So see, this comes under the function, under the importance, under the characteristics as well of the capital market. It serves as a link between the savers and the investors. Okay, that means savers means what? Who has surplus of money with them, and the investors means the company who is going to take the money and invest in some different kind of businesses so that they can earn profit or generate revenue out of it. Okay, so ultimately it will turn up into capital formation. So the capital market acts as an important link between the saver and investor. Okay, so this we have already discussed, so I'm not going through this point again. So the next one is basis for industrialization. So capital market generates long-term funds which are essential for the establishment of industries. Thus, capital market acts as a basis of industrialization. Okay. And the next one, accelerating the pace of growth. How it accelerates or helps in the growth of the economy. Okay, so easy and smooth availability of fund for medium and long period encourages entrepreneurs to take profitable business in the field of trade, industry, commerce, and even in agriculture part. So it results in the all around economic growth and accelerates the pace of economic development. Definitely, even there are many companies who are in need of fund, who are in need of finance. So if there is a one place where they can get the money or finance as and where required, because there they can get some kind of investors or savers who has surplus of money with them. So this is a platform. The capital market is a platform for the companies, so they can get the money easily. Okay, so it's a kind of motivation to them that I am going to get the money definitely, and it will boost up the morale of the entrepreneurs that if I'm going to get the money, I'm going to invest in this particular way so that it will be a growth in the economy. Because if they are going for some other businesses, that means definitely they are going to give some kind of job generation, they're going to earn profit. Ultimately it's the kind of economic growth. Okay, next one, generating liquidity. uh, so what liquidity means? Liquidity means here we will just understand the term what is liquidity. Liquidity means the company should have enough assets, or enough, we can say, money or assets to repay their, we can say, the liabilities. Okay, whether they have enough assets to repay their liabilities or not. For example, we mainly focus on the current asset and current liability. Okay, we have a current asset and current liability. Current assets are actually those assets which can be converted into cash within 1 year. Okay, like the cash in hand or cash at bank or marketable securities or inventory maybe. Okay, but what is current liability? Current liability are those liabilities which is needed to be paid by the company within 1 year, like any kind of short-term loans if they have taken. Okay, so here we have to see whether my current assets are enough to pay my current liability for this particular year or not. If not, that means the company is not liquidate enough. Okay, the company is not liquidate enough, like means if they are not able to repay their liabilities or the debt, that means they will be in the false position. Okay, their goodwill will go down and the market share will also go down. Okay, so they have to manage this properly in a better way, and they have to keep a balance over there between the assets and the liabilities. So here liquidity means convertibility of or into cash. So shares of the public companies are transferable. That is, in case of financial requirement, these shares can be sold in the stock market and the cash can be obtained. This is how capital market generates liquidity. Now here I'm not we talked about liquidity only, right? But in case of capital market, here the term that generating liquidity means that whenever you are purchasing, suppose you have purchased the company share, okay, fine, but now I want to sell it. So where is the marketplace? The marketplace is the capital market. I can easily sell it out whenever I wish and I can get my money back. Okay, so it helps in liquidating. Whenever I need it, I can just sell it and get the money. Whenever I want to purchase it, I can just purchase it. Okay, so it is a kind of proper marketplace where we can buy and sell. The next one is increase the national income. So fund flow into the capital market from individual and financial intermediaries, which are observed by commerce, industry and government. So it does facilitate the movement of stream of capital to be used more productively and profitability to increase the national income. Okay. And the last one is capital formation. So the capital market provides incentive to saver in the form of interest and dividend, as we talked in our characteristics as well. So how it generates capital formation, because they are getting the interest, okay, the savers, they're getting the dividend, okay, ultimately they're gaining money out of it. Moving on to the next slide. Here you can see capital market are divided into two markets. One is primary market and another one is secondary market. So what is primary market? See, in simple terms, if we need to understand this, primary market means it is a market where new companies, or we can say the existing companies maybe, uh, now they are issuing the shares for the very first time. Okay, so whenever the companies are issuing the shares for the first time, they issue the share in the primary market. So here it's written that first time sale of securities, that is IPO, initial public offering. Okay, once the company has grown, now they want to get listed. So before getting listed, they make their shares available to the public so that the public can purchase their shares. So this is known as the primary market. Primary market means the new shares of the company are being traded over here. First time they are being offered to the public, which is known as initial public offering. Now, company sells to investors, company fixes price, firm raises firm for long term. Okay. Here, secondary market. So what do you mean by secondary market? Secondary market means, see, first time when the company has like what to say, company has sold their shares, it was in the primary market. Now suppose initially you all may be knowing that a few months back we had an IPO of LIC, right? We had an IPO of LIC. Now suppose I have purchased the IPO of LIC. I got certain number of shares, suppose 50 shares. Okay, now I purchased at 500 rupees each share. Okay, just an example. Now the price of the share after LIC got listed in the stock market, the price of the share went up to suppose 1000 rupees. Now there is a difference of 500, right? That I purchased in 500, but now the share price of that particular share of LIC is 1000 rupees per share. Now I want to sell it. Do I'm going to sell it in the primary market again? No. Okay, this primary market is not for selling these things. So initially when I'm going to sell the shares, whatever I have purchased from primary market, it will go into the secondary market. Secondary market means it's a kind of we can say second hand shares. Okay, it has been already issued for the first time in the primary market. Now I have purchased it, I want to sell it again, I'm going to the secondary market. So existing securities are bought and sold over here. Okay. And prices are determined by demand and supply. So you have seen the stock market, right? We have stock market, basically two big we can say exchanges. We have NSE and BSE, which is National Stock Exchange, and Bombay Stock Exchange. So the price of the we can say the shares of the company, it depends upon the demand and supply. If the demand is more and the supply is less, definitely the share of that particular company will rise. Okay, will go up in the up direction. Now here, means of raising primary funds in the primary market. So how we are going to raise fund from the primary market? First option is that we can go for IPO, that is an initial public offering. That means it is a process when an unlisted company raises fund by offering a share to the public and consequently get listed in the stock exchange. Like we have discussed now about LIC. See, LIC was not listed before, so they what did they do? They just provided their share for the very first time, okay, through IPO. So once IPO was done, they got listed in the uh, share market. Okay. Next one is follow on public offer. So follow on public offer means that when a listed company comes out with a fresh issue of share or makes an offer for sale to the public to raise fund, is known as FPO, which is follow on public offer. There is one thing that it is an issuance of additional share made by a company after initial public offering. See, initial public offering, that is IPO, is done by the companies who are not listed in the share market. Okay, but this follow on public offer means that suppose the company is already listed. Okay, the company is already listed in the stock market, but they may have fresh shares, they may want to issue new shares, so they can do it in the primary market again. Okay. Next one is preferential issue. Preferential issue means it refers to the procedure of bulk allotment of fresh share to a specific group. They specify to whom I'm going to sell or provide these shares. Okay, like it can be some venture capitalist, it can be some company, it can be an individual or person. Okay, so it is decided by the company itself that to whom they are going to issue the shares. Okay, now next one is right share. What is right share or right issue? It means that issue of shares to existing shareholders or to a small group of investors, okay, in the proportion to their existing shareholdings. Now right issue means they are going to issue the share to the existing shareholders itself, but on the basis of their shareholding proportion, how much share they have now, on the basis of that they are going to give this extra shares to that particular existing shareholders. Okay, and the last one is private placement, sorry. So when a company offers a security to a small group of investors is called as private placement. So such securities may be bonds, stock, or any kind of securities, and investors can be both individual and investors. So privately they are going to do it, maybe to any kind of individual or maybe to any kind of what to say, small group of investors. Okay, so I hope up to here it's clear what is a financial market, what is capital market, and what is the main objective of this capital market or importance of capital market, along with it the primary market. Okay, and from primary market how we are going to raise fund. So for today we are ending here itself. So in the next video we will discuss more about for example, we are going to study about the secondary market. Okay, we are going to see what secondary market is, what are the different types of issues that can be done over there, what is equity share, what is preference share. So these things will be done in the later videos. Thank you so much for today.